You wanted to get started investing. You did some research, you went on YouTube, you watched these videos. You took some notes, opened up your stocks and shares ISA, and made your first investment. You then wait a few hours and you're a millionaire. When does that part happen again? Well, not quite so fast, and as much as it might appear that investing can change your life, lots of people seem to miss out on some very important points, which I really think you need to know before you get yourself started on the journey, otherwise you'll probably just end up giving up before you get there. That's why I've put together the top 10 things that you don't get told before you get started. Think of it like an anti-establishment guide to investing. Starting from the top in no particular order, here goes. One of the biggest things you get told is that investing to make money takes a really long time. And when I say a long time, I mean a really long time. There's no shortcuts to this, and the only quick way to make a million is either starting with millions in the first place or winning the lottery. The whole concept of investing your money is that you're trading your cash today for greater future returns, and you hope that over the years, the market will reward you and make you a lot more than you started out with. And while that might work out, and it's my strategy too, I know that investing a few £100s a month isn't suddenly going to turn into thousands of pounds overnight, and as we'll touch on later, there's no guarantees about what might happen, certainly in the short term. If you want investing to be exciting as you put your money away over the years, I'm afraid you're probably very much in the wrong business. This thing's long term, it's mostly very boring, although I do my best to make it as exciting as possible on this channel, so we can have some fun along the way. This next point should be a reassuring one. You don't need to know 90% of the information out there in the stock market. How to value companies, what a balance sheet's made up of, and how to calculate a profit margin. In fact, if investing was tied to intelligence, then you'd expect the smartest people in the world to be the best investors. A direct link between IQ and returns. It's just not the case. In fact, you could even find that it's quite the opposite. Warren Buffett reckons you just need to be moderately good with numbers to assess companies with no more skill than you'd get from general education. Oh, and don't forget that one of the smartest minds in history still got swept up in the stock market crash. Isaac Newton himself, considered to be one of the greatest mathematicians and physicists who have ever lived, still ended up investing back in the 18th century into the South Sea Company, one of the greatest stock market bubbles of all time. So don't be too hard on yourself. He got swept up in all of that excitement and got massive FOMO, so he bought in all of the highs and sold during all of the lows, which sounds really similar to some of the popular finance creators here on YouTube. Following on from this one, our next point is making sure that you don't fall into one of the greatest traps that beginner investors face. What some people will start to talk to you about, like how many stocks you need to own, what kind of companies you need to buy, and where in the world you need to invest, all falls apart when you realize some very simple concepts that are just objective truths. If you use low-cost index funds, in the long term, you'll end up beating the vast majority of stock pickers and active money managers. Just take a look at this data here showing even during 2021, one of the greatest years for stocks when the S&P 500 made over 28.7%, just under 80% of actively managed funds underperformed the market. For all of the brains and money that's out there on Wall Street, beating the market is not easy to do in 1 year, let alone over the very long term. As much as they'll try and get you interested into penny stocks, which apparently will 10x in the next year, or even a new exciting tech and innovation fund from a smart talking manager who's had a couple of great years, in the long run, they rarely ever win. And even in the best case scenario that they do, it won't be worth spending all of your time to find them if the additional performance is just a tiny additional margin. If you need proof, look up Warren Buffett's own $1 million bet against hedge funds a few years ago. And also look at all of the actively managed funds' performance over the past few years and long term. It's not pretty. Just before my next point, if you're enjoying the video so far, please drop me a huge like on the video and consider writing me a comment below. It really helps out small UK finance channels like me to get to more people like you, which is good, right? Anyway, with that like button turned blue, let's turn to our next point. Next up, as much as we'd love to think we're all going to be great investors and create the best portfolio, I'm afraid that the perfect portfolio doesn't exist. It's like trying to search for the Holy Grail, and you can chop and change as many different stocks, bonds, commodities, and properties together as you want, but either way, we've got no idea what the future will hold. And we've only got the past results to go on, so nobody really knows what's going to happen next.
'Tis but a scratch.
There are definitely things we can do to help ourselves, and we can use strategies like dollar cost averaging, meaning that we invest every time we get paid into something like a low-cost, well-diversified global index fund. And we can also remain consistent over the long term, making sure that we buy even when the markets are in a downturn. But I'm sorry, we can't make anything that's guaranteed to perform. But hey, that's what makes things fun and interesting, and all part of your own investing journey. If we all thought the same and were interested in the same things, life would be pretty boring, wouldn't it? In the meantime, if I do find the perfect portfolio, I'll let you know. I need to really check behind the cushions on the sofa. For this next tip, it's one that always gets left out, but worth mentioning before you start picturing what it's going to be like as a millionaire by the time you've retired. You have to adjust returns for inflation. Now, I'm guilty as much as anyone else is when I say, if you invest this much each month for 30 years and you get this much interest on average, you'll end up with £1 million as an example. And while that's true, remember that £1 million in 30 years' time won't be the same as £1 million now. Money loses its value over time with inflation, which at the moment is running super high. Unless you're getting a pay rise this year in the UK of over 7%, you're actually losing money in real terms as the cost of living rises, and this also affects your investments too, meaning that they also need to grow more than 7%, otherwise you're pretty much in the same position in real value terms. Let's just take another example. Just think, the average house price in the UK right now is £277,000, an increase of 10% just the year before. However, if we say that house prices increase on average 5% per year over the next 20 years, the average house price ends up at £750,000. So pay attention to inflation and be realistic with your returns. Given enough time far into the future, even the minimum wage will be over £1 million a year. Although by then we may have moved to Mars and be using Dogecoin for all I know, if Elon Musk has his way with the world. For those investors who do start to get involved in picking individual stocks and looking at the financials of a company, remember that the share price and the company are two very different things. You can completely love a company, own it and use all of their products, but not be willing to buy the shares because it looks just too expensive. The price of a share and the value of the company overall might be quite disconnected and stay that way for a really long time. I mean, just think of Apple as an example. You might have loads of their products right now at home, and we know that they're a great company that makes a hell of a lot of money, but the stock price at any given moment in time could be super expensive or super cheap, and we'll never really know because the whole market is a game of opinions and sentiment anyway. But the point remains that if I said Apple stock is right now £10,000 a piece, you'd say, whoa, that's too much. But if I said, oh, it's just £10, you'd be remortgaging your house to buy loads. And this could all happen while the company underneath just goes about its business as normal. So be careful and remember that the price and the company are two very different things. Now, one of my favourite topics is really interesting to look at is the psychology of investing. The bottom line here is that we're all our own worst enemy. Being human, we all suffer from this condition where our emotions can get a hold of us and we make irrational decisions all of the time. And even when we think we're doing the right thing, we're actually just kidding ourselves and justifying our own behaviour by making up whatever story works in our heads. The only way we can really cure ourselves here is just by making sure that we're aware of all the different biases we have and trying our best not to let our emotions ruin our investing decisions. This is always easier said than done, and I'm not perfect by any means, but if you can stick to your investment plan, not buy out of excitement or sell when things are getting bad, you should put yourself on a pretty solid path. Oh, and you don't have to be very intelligent to do this either. Remember what happened to Isaac Newton earlier?
One of history's most famous apples.
There's a good reason that people always quote Buffett when he says that the stock market is a tool for transferring wealth from the impatient to the patient. That's not impatient like hospital, impatient, opposite of patience. On a really bad day in the stock market, turn off your phone, go for a long walk outside. That's one option for you at least. This one's a funny one and links back to a lot of the other points we've already gone through. Just for the record, you don't need to buy 5 hot stocks this week or this amazing dividend company that suddenly crashed in price. In fact, you don't have to do anything at all. Nobody ever made a loss on a stock by not buying it in the first place. We're all perfect investors in hindsight. I know platforms like YouTube or even places like the financial columns in newspapers will always be filled with the latest hot stock tips. Remember that they need something to talk about, otherwise they'll be left with nothing to say. Plenty of pundits will run to the latest hot stock pick or whatever commodity is suddenly performing well, and they'll make sure that you know that you could have missed out on massive gains. The bottom line is that you don't need to do anything at all. Instead, I much prefer to keep a close eye on some of the well-known plays from the outside, make a note of the companies they've been pumping, and then you can have a really good chuckle at them later on. Really, how some of these people continue to keep going week by week is beyond me, but hey, they keep getting the clicks. In number 9, this one should be a bit more obvious, but nobody knows the future and no one knows what's going to happen next, especially when it comes to the price of shares. I think I'll let that scene from The Wolf of Wall Street play out now.
Fairy dust.
So just remember, whether you're browsing through YouTube or whether you're looking through different press or different newspapers and someone gives a hot stock pick or says that they think a certain thing might happen, It doesn't matter how intelligent these people are, what kind of qualifications they have, because anything could absolutely happen. At the end of the day, everyone's playing a different kind of game. Some people are in for a short term, some people are just traders looking to make a quick buck off the top or the bottom, and other people like me or you is really looking for that long-term gain as an investor. So, the bottom line, if someone says they know the future, I would run very, very far away. And this leads me on to my final point to round off the 10 things they don't tell you. And it's a bit of a bonus one, but if my time investing and being in the community has taught me anything, it's always inverse Kramer. That's right, good old Jim Cramer, the former trader and now super famous TV pundit, is just as liable to bad stock picks as you or I. If anything, when he gets excited about a stock and says to buy it, apparently you're now meant to just do the opposite and you're almost guaranteed to make a return, but I'll let you make that trade. Whether it was Peloton, DD, Alibaba, or more recently Netflix, he's shown a bit of a track record of getting pretty excited when stocks are high and then just kind of forgetting about them once they're down.
Got my blessing to bet on DD. I would try to get as many shares as you can. DI.
He's got a tough old job trying to keep up with many stocks all the same time and trying to have an expert opinion. Unfortunately, he's a human just like the rest of us. So don't forget, inverse Kramer. Now, if you want to know everything that you do need to know about investing, you'll be interested in my complete beginner's guide to investing here, or if you know the basics already and want to look at something else, then why not check out my latest Vanguard portfolio update, where I go through all of the latest goings on in the stock market and show you what I'm invested in with my Vanguard stocks and shares ISA. Until next time, don't forget to drop me a like on the video, subscribe for many more, and as always, happy investing.